The collapse of the US commercial real estate market is getting even worse, with values for apartments, office buildings, and retail now down 11.2% from a year ago, with some buildings down by as much as 90% in value. These declines in commercial value are now intersecting with a massive wall of debt that has the potential to send the US economy and the US banking sector into a credit crunch, which is inevitably going to increase the unemployment rate, cause a lot of layoffs, and reduce consumer spending. That's because banks have massive exposure to the commercial real estate sector in America. Almost $3 trillion in commercial real estate debt is held by US commercial banks. Now that that debt is coming due, with the valuations going lower, lots of landlords of office buildings and apartments are defaulting. For instance, Brookfield Corporation, one of the largest asset managers in the world, think of them as the Canadian version of BlackRock, just defaulted on a $161 million mortgage for office buildings around Washington, D.C. And why did they default? Well, the occupancy rates for these buildings fell from 79% to 52% over the last 4 years, while at the same time, monthly interest payments jumped from $300,000 to $880,000 due to the Federal Reserve interest rate hike, which is a massive double whammy occurring for owners of office buildings in particular in America. They're dealing with a secular downturn in companies wanting to lease office space due to an increase in remote work, to go along with number two, interest rates that are now much higher when they go to refinance their debt. And there's a lot of debt that needs to be refinanced in the commercial real estate sector going forward. Bloomberg reporting that there's a $1.5 trillion wall of debt looming for US commercial properties. In particular, Morgan Stanley sees massive refinancing risks, and they're predicting that valuations could fall as much as 40%, with $400 billion of this commercial debt maturing in 2023, $500 billion in 2024, and $470 billion in 2025. As more of these landlords go into default on their mortgages, many are just walking away from these office buildings or malls or retail centers or apartment buildings. They're just handing back the keys. When the bank and the lender takes over, they're going to have to write down the value of that loan significantly on their income statement and balance sheet. It will inhibit their ability to make new loans and also potentially cause more bank runs as depositors start to be wary of the financial health of the banks that they have their money in. In particular, it's small and regional banks that are the most exposed, with data from the Federal Reserve showing that small and regional banks hold nearly $2 trillion in commercial real estate loans on their balance sheet compared to only $900 billion for large banks. And what's even scarier is that nearly $2 trillion that small banks are holding in commercial debt accounts for nearly 40% of all the deposits that they're holding. And so what that means is if you bank with the average small regional bank in America over the last couple of years, they've been taking your deposits and then loaning it out on commercial real estate projects, so that now these commercial loans account for 37% of their total deposits, which is by far the highest asset allocation that these small banks have. Residential loans is half that level. US Treasuries is half that level. Credit card debt's only $450 billion compared to the $1.9 trillion in commercial loans. And so what I predict is going to happen in the second half of 2023 and into 2024 is that more of these small and regional banks are going to have to cut back on new lending into the economy, which is going to trigger a credit crunch, depriving businesses and individuals of liquidity and capital, which is inevitably going to increase the unemployment rate, cause a lot of layoffs, and reduce consumer spending. And why this is so important for you guys watching this is that there's people who think that somehow the US economy is going to dodge a recession and that there's going to be no landing and things that are just going to be good. But folks, there's a very small chance of that Goldilocks scenario happening when there's a credit crunch that's already occurring from the banks. And you can see that basically the amount of loans has not grown since about late February. So over the last 4 months, there's been no growth in loan volume coming from banks in America, which is a big problem for the economy. Because when we look at the percentage change in loan growth historically, we can see that anytime there's a big deceleration in loan growth or it goes negative, like in 2008, like in 2001, like in 1990, like in 1974, there is a recession that occurs simultaneously to that big deceleration in loan growth. And what's concerning now is that the flat loan growth over the last 4 months now leaves us at only plus 5.9% over the last year, which is still positive year over year. But you can see we are heavily decelerating on loan growth from commercial banks into all sectors of the economy. And this will likely continue to go down over the next year as the commercial property crash gets worse. And what's especially scary to me about this is the size of the commercial real estate market and the amount of debt that exists out there in the commercial real estate market, because we talked about how banks hold 3 trillion in commercial real estate debt. In addition, there's probably another 2 to 3 trillion in the commercial mortgage-backed security market as well as the private market. So let's just say 5 to 6 trillion total in commercial loans in America. If you compare that to, for instance, the subprime crisis in 2008, there was only 1.3 trillion of subprime debt in 2007. And of course, that 1.3 trillion in subprime debt caused a massive collapse in both the housing market and the global economy. And so we have debt levels that are above that in the commercial property sector, with properties that could, in many cases, be written down by 30, 40, 50, even as much as 90% or a total loss. For instance, an office building in St. Louis called AT&T Tower that originally sold for $200 million 16 years ago recently appraised at only $9 million, marking a 95% decline and a nearly total loss for the bondholders who foreclosed on the building. But it's not only office buildings that are in trouble, everyone. It's also retail, where a big increase in online shopping during the pandemic has structurally reduced the amount of people going into retail shops and buying goods and services. Additionally, the apartment and multifamily sector is having issues as well, with the decline in apartment values over the last year measuring 12.5%. That's actually the highest of any commercial real estate asset class, according to data from MSCI. Why are apartments going down the most in value? Well, a couple different reasons, everyone. Number one, rent is going down. Number two, operating expenses are going up. But most importantly, number three, most owners of apartment buildings who bought over the last couple years bought at a microscopically low cap rate or rental profit yield, with data from CBRE showing that in the second half of 2022, cap rates for Class A multifamily suburban properties ranged from anywhere from 4.5 to 5%, meaning the landlords are only getting a 4.5 to 5% return, which was fine when interest and mortgage rates were artificially suppressed over the last 2 years. But now that interest and mortgage rates have surged, those cap rates and yields are no longer good enough. So now you can buy a 1-year US Treasury and get a 5.4% return, which means that you, from your couch, can get a higher return than professional apartment developers and owners by just buying a US government bond, which is a big problem for these apartment owners because the opportunity cost of capital says that it's a bad idea to buy apartment buildings. In addition, their cost of debt is now surged above their profits, with the cost of debt now hovering from 6.5 to 7%, which is way higher than the cap rate of 4.6%, which means they are losing money when they go to refinance. And a particular issue for the commercial property market as opposed to the residential market is that the loan terms and durations are much shorter. So when an apartment owner or an office building owner or a retail strip center owner goes to take out a mortgage, it's typically only for 5 to 10 years compared to the 30-year mortgage that you guys are familiar with for a home buyer. And so a 5 to 10-year loan term means that there's a lot more refinance activity, and that refinance activity is hitting now, just as interest rates have surged, just as revenues are going down for these asset types, which is going to cause this downturn to get even worse in the commercial property sector. And ultimately, I think there's going to be a spillover impact on the US housing market, because as commercial property values go down, as the defaults increase and banks are forced to cut back on lending, that's going to trigger a worsening recession with more layoffs and job losses and bankruptcies and liquidity needs. And so when we have a worsening recession where people need money all of a sudden, what are they going to do? They're going to sell their house, particularly if there's someone who owns multiple Airbnbs or multiple investment properties, or if there's someone who simply gets laid off and defaults on their mortgage. There's 12 million homes in America that are vacant right now. There's 17 million homes that are owned by investors and landlords. There's lots of different ways that we can get a big inventory spike through a bad recession caused by this ongoing credit crunch. But of course, more and more people are now thinking that we're not going to have a recession. They're saying to themselves that this isn't going to happen. And they look at things like the US government job statistics, which just announced that we added 200,000 jobs in June. And they say to themselves, well, there's no recession. We added 200,000 jobs. But what these people don't look at is they don't look under the hood at the data that the US government is producing. Because yes, total non-farm payroll employment increased by 209,000 in June. However, when you break into the details, you realize that they revised down employment from April by 77,000 and also revised down May by 33,000. And so they took away over 100,000 jobs they said we added in previous months, which means that the net job growth this month is only 100,000, which is not very good. Additionally, another big headwind for the economy that increases the chances of a recession and forced selling in the housing market is where mortgage rates are going. Mortgage rates and long-term treasury yields, they have spiked over the last week or two. 30-year fixed mortgage is now hovering around 7.14%. A really tough pill to swallow for home buyers in the housing market in the middle of 2023, with prices that are still very, very high. And what we're beginning to see now as we enter the summer is a seasonal slowdown in people looking for homes. We're exiting that peak seasonal period in the spring and now entering a summer and fall period where traditionally sellers cut the price by more and houses sit on the market for longer. And to get a sense of this, let's look at data on the number of days on the market for houses in a metro like Nashville. What do you see is that there's a very cyclical nature to when houses are on the market for a short amount of time and a long amount of time. Basically, days on the market tends to bottom around May and then start increasing, and then it peaks in the winter. And we're starting to see that in Nashville, where days on the market bottomed in May. Now it's going up to 34 days. And in future months, that days on the market is going to continue increasing, and sellers are going to face more and more pressure to cut the price before the dead of the winter. And so what I predict we're going to see in the second half of 2023 is that, seasonally speaking, on its own, home prices are going to begin going down again. And that's going to cause lots of people to freak out, because lots of people bought into this idea that in the spring, because prices went up a bit in the spring, that the housing crash was over, but they forgot that prices always go up in the spring. That's normal. Even during the initial stages of the 2007-2008 crash, we saw prices go up in the spring of each year. So now these people who bought into this deluded idea that there was a housing market recovery are going to be shocked to find that prices are going to start to go down again. And what I think is going to happen is we're going to see prices start to go down for seasonal reasons, combined with an increase in distressed selling from investors, Airbnb owners, people who are facing increasing liquidity needs, which is going to put more new listings onto the market in a time of year where that typically doesn't happen towards the end of the year in 2023. At the same time, this commercial property crash is going to continue to get worse. Landlords are going to continue to hand back the keys on office buildings and malls and apartment buildings around America, which is going to lead to banks constricting liquidity into the economy, and it could lead to even more bank runs, which could trigger further deflationary forces in the economy, which brings down real estate prices across the board. And ultimately, I'm not 100% sure that it's all going to play out in the way I just described, everyone. This is just me looking at the data, but I can tell you, if you're someone who's buying into this narrative that I see increasingly floated, that there's nothing bad going on in the economy, that the housing market downturn has bottomed, you better be very, very careful. Because what's building in the background here with the commercial property market and the banking crisis, as well as the issues that I talked about in my last video with rent declining, it suggests there's more pain to come for the US housing market.